Hello everyone and welcome to today's webinar, Demica Insight Q3 2021, the technology revolution in B2B payments. Before we get started, I would like to go over a few items so you know how to participate in today's event. You have joined the presentation using your computer's speaker system by default. Please use your speakers or plug-in headphones to access audio. You are in listen-only mode, but you will have the opportunity to submit text questions to today's presenters by typing your questions into the questions pane of the control panel. You may send in your questions at any time during the presentation. We'll collect these and address them during the Q&A session at the end of today's presentation. Today's webinar is being recorded and you will receive a follow-up email within 24 to 48 hours with a link to view the recording. I would now like to introduce Matt Reeford, Demica's CEO, to begin the webinar.
Hi guys, welcome to this quarter's webinar. So as we published, the agenda for today is going to cover three particular topics. The first is covering off the economic trends of the data coming off our platform. What are we seeing in our data, and what are the messages we're going to draw from that? That'll be about around 10 minutes or thereabouts of this webinar today, and then we're going to move into a discussion around B2B payments and how the landscape is changing and evolving over time. And finally, we're going to look at how that's going to impact supply chain finance and how that's going to democratize it and bring more of the long tail into the scope of the product. So that's the overall piece. Please submit questions as we go along. We'll also keep some time at the end for questions as well. So at this point, I'm going to ask each of us to introduce ourselves and then we'll kick off. So first of all, I'm Matt Reeford. I'm the CEO of Demica. I've been running the business for the last 7 years, leading its transformation into one of the largest supply chain finance platforms in the world. And I'm really pleased to be joined by my guest today. I wonder whether, Megan, you could kick us off and introduce yourself.
Sure, thanks so much, Matt. Good morning, good afternoon, everyone. And I'm Megan Kels, and I head up BMO Financial Group's North America Treasury and Payment Solutions and Trade Finance product team. A little bit about BMO Financial Group for those that may not be familiar on the phone. We're the number 8th largest bank in North America. We have about $971 billion in assets and about 12 million customers, and a presence in North America, the UK, and Asia, primarily Singapore, China, Hong Kong, and Japan. And I have accountability for the payment side, as I said, sort of the traditional products, whether those be wires, ACH, EFT, as well as new digital products like Global Pay, Zelle, and then the entire trade finance suite for BMO. And I'll pass it over to David.
Thank you, Megan. Thank you for having me, Matt. My name is David Trecker. I lead the business-to-business payments organization at Mastercard. Within business-to-business, we focus on virtual card solutions, where Mastercard is the largest player in the world, as well as B2B network solutions like Mastercard Track, and as part of that, non-card rails related solutions, for example, Track Supply Chain Finance, as well as a variety of services to support the accounts payable and accounts receivable process for and with our partners.
And Greg. You're on mute, Greg, I think.
Sorry about that. Of course, the one thing I forgot to do. Nice to meet everybody. I'm Greg Blows, CEO of Transcard. Transcard is a fintech company. We focus on integrating between ERP legacy systems, the banks, as well as the various rails for payments. We have several solutions for embedded payments for both B2B and B2C payments. Look forward to this conversation. Nice meeting everybody.
Well, thank you, all of you, for joining us today. So we'll start off with a discussion on the economic trends. It's readily apparent to everybody on this call that there has become a really significant mismatch between supply and demand. So the green line there shows you order volume rising very steadily pretty much every month during 2021, and yet the actual invoice flow is very, very stable. And this, of course, is being driven by the disruption in the supply chain that we're seeing in lots of different places across all of our businesses. And the real problem, I think, has been a whiplash in demand as the pandemic has passed in various different countries. There's been an incredible rise in orders across a wide range of different sectors. And what we're then seeing is that disruption in the supply chain causing further problems where people, because the logistics are taking longer to ship it, purchasers are then ordering even more inventory to try and compensate for the disruption in the supply chain. So this is going to be a really significant issue that's going to flow through into 2022. And I think all of us see it in different ways. I don't know, Greg, whether you'd like to share any thoughts you have and what you've been seeing here.
Yeah, a couple items. One, the supply obviously is disrupted greatly. I'm even last week heard that there were over 200 container ships off the coast. What was interesting is that the highest that had ever reached before was around 52. So supply, continues to be plagued, and will happen so in the next year. The other interesting thing, anecdotally, or what I'm hearing is, for years we've been hearing about the changing labor force, that with all the baby boomers retiring, with COVID, and we obviously see it impacts in the buyer and supplier aspects of it, but there's also an underlying impact to the skilled workers, because COVID has actually advanced a lot of the retirements, and so companies are losing skilled workers. Productivity seems to be challenged right now. So it is all around, impactful to businesses.
And from your perspective, Megan, when you look at what's happening to your clients at BMO, what do you think the things that come most to mind to you?
Well, one thing I just wanted to add on, Matt, to Greg's comment is around sustainability. So when you think about trade finance, and there's such a huge role to play, and in terms of environmental, social, governance perspective, despite the fact that buyers have reduced suppliers, and there's an overall shortage in the industry, as you've talked about and Greg's talked about, we're not seeing buyers hold back in terms of ESG suppliers. In fact, where they have a choice and the suppliers aren't living up to those commitments, they're pausing and or causing, not to go with that supplier at all. So that's sort of been an interesting trend that we've really noticed across North America, that despite there being a pretty significant shortage, and you're going to talk about it in a few key areas in a few minutes, ESG is still really being promoted and implemented by the buyers at large.
And we've certainly seen that ourselves. We announced a supply chain finance program with the IFC a few days ago, working with Barry Callebaut, one of the world's largest chocolate firms. And that's all driven by ESG for suppliers in emerging markets. And to your point, they're prioritizing flow and purchase to the right suppliers who meet their sustainability on a socio and also agronomic basis. So we see that being a significant trend, that's been running for a while, but we're going to see it pick up even more from where it is. David, any other observations from you before we move on?
Sure. So perhaps as a derivative to this point, we are seeing sources of supply shifting, and notably to not just e-commerce, but marketplaces in particular for B2B spend. And that has some interesting knock-on effects. It tends to change how payments are made. Just so happens more of those payments go through cards. But it also then changes how the working capital solutions are offered to those end suppliers. For example, how these marketplaces acting as intermediaries and baking financing into their commerce proposition.
And in the conversations that we've had with large banks, this is something that we have seen as well. People have talked about the demand for inventory finance for providers and sellers on those marketplaces has been rising really, really rapidly, particularly because with problems in the supply chain, people are bringing more inventory onshore into Amazon's warehouses or elsewhere. And so I think that this is a webinar on supply chain finance, effectively a receivables or payables product, but we shouldn't overlook the importance of inventory and what that's going to do for demand in partners coming from here. So if we then move on and just look at some of the key sectors that's coming off our platform, Demica is very, very involved in the technology space, both in hardware and services. The 20 billion or thereabouts that's being run on our platform at the moment, this is nearly 40% of the total funding outstanding today. So it's an incredibly rich and deep data source. What you can see here is it's the graph or the axis on the left is set at 100, i.e. that's the volume of spend in January 2020. This should be always sitting around the 100 level. There's always cyclicality, or sorry, seasonality with high-end quarters in this sector, but never before in the 2018 and 2019 data have we ever seen it go above about 125 at quarter end. So when COVID kicked off in March 2020, you can see it went up to twice the volumes of the January. So we reached over 200 of normalized spend in March. But what was fascinating was throughout 2020, the volume stayed incredibly high. And only in 1 month, in August, did it ever drop below the January end sort of starting point. I have to say, we thought that what this was doing would be likely pulling forward spend that was going to be made in later periods, right? And that therefore what you would expect to see is a significant drop off in orders later on. And it didn't happen at the end of 2020. But nor, by the way, as you can see in the orange line, did it actually happen in 2021. We genuinely seem to be in a new order now, right? Where the amount of money being spent on digital services and hardware to support them is running now at nearly twice the normal levels. So watch this space to see what the last quarter is like. But it's quite remarkable what has happened in this area of the market. Now, you would have thought that potentially the problems in the chip area of the supply chain was going to flow through, right? We'll see it later on when we talk about automotive. But at least these areas of the market, which is more sort of in laptops and servers and sort of computer hardware, as opposed to embedded industrial electronics, have continued to be able to source the necessary supplies that they need to continue selling on to their customers. So really exciting part of the market for these guys. If we move on though to another area, which is normally historically very stable, paper and packaging, right? Used across a wide range of different sectors. 2020, you can see was pretty stable, slight uplift in some of the quarters. By 2021 though, we've seen a sustainable increase in demand. And this is not just about volume, it's also to do with price. And we believe, looking through the underlying data, that this has been a major pull through due to e-commerce, and the mix of packaging that's being sold is more related to consumer packaging and away from industrial. And the demand for that has continued to build, as you can see, over the first 9 months of this year. And at this point, I think I'd invite you, Greg, to show us any observations you have.
There's no doubt the amount of e-commerce has gone up dramatically over the last year. What's interesting, we always look at elements from the payments perspective, and e-commerce driven a lot by the consumer, the ability for the consumer to purchase from the house and facilitate the payment easily when doing so. The whole kind of B2C or even personal person-to-person payments, really even before COVID, was advancing, rapidly. Lots of new ways to make payments and facilitate interacting with a customer, so that it was natural for this to increase during this period of time. What is interesting to us is the B2B side of the payment world has really lagged. It is something that has not innovated, very, very rapidly to date. There's a lot of great things that we'll talk about today that are going on with regards to B2B, but it really has lagged the B2C space. And so this, to me, is indicative of a great trend line. If we get the B2B play right, I think we'll naturally see these increases across multi aspects of the whole buyer-supplier payment chain.
And if we think about that as a stable environment, now here's some data on something that really has not been. So this is data from the tier 1 automotive suppliers. So these are the suppliers to Volkswagen, Peugeot, Fiat. So this is principally in Europe. And you can see anything other than a stable trend. 2020 started really well for them, and then the just-in-time supply chains were shut off, as everybody's well aware, in the start of 2020 in sort of Q2. and precipitous drop down to 40% of prior spend. And while it recovered during the summer, then further shutdowns across Europe, we saw the supply chain volumes decline. And then very problematically for this sector, the shortage of chips and other key components have basically flowed through into 2021. And you can see that the actual amount of spend in the supply chain has remained depressed for the last 9 months, right? Below that 100 level, the January 2020 starting reference level. And I suspect, but I don't know, Megan, that this is probably seen also in North America.
Thanks, Matt. Yeah, a very, very similar graph for North America. Semiconductor chip shortage as well, considerably constraining manufacturing volumes in North America, which has reduced sales volumes for us to pre-COVID levels. It's constrained not only due to chip shortages, but also due to the shortage in aluminum and steel in North America. So the bright spot is for this constrained supply, it's really driven up record levels for new and used vehicle pricing levels in North America. I attempted to buy a car this spring myself and can assure you that it was a long search and not the price that I wanted to pay. And the expectation in North America is that it really won't normalize until later in 2023, and there's scarcity in both the new and used market across North America.
Sorry, just to pause, you said 2023. So
Yes.
you're seeing another sort of 14 months or more of disruption in this sector.
That's right.
You better bottle down and buy that car now then. Wow. So the thing that's also coming off the back of these disrupted supply chains is increased financial stress, right? And I think that the bit that we'll see from our data is increased past dues are rising. The chart on the left shows you the percentage of sales where people are over 30 days past due, and you can see the percentage on the right for 60 days past due. Both show a consistent gradual rise over time. You can see the spikes in 30 days past due in April and May, as you'd expect. The initial part of COVID, people held off from paying their suppliers. Then they got actually by sort of November well above well back on track as government money flowed in around many of the economies in Europe and North America. So that sort of steep drop off you can see, but the trend has picked back up again. Stress is increasing. We see in our invoice data, but I don't know, David, do you see this in payments as well in your data sets?
And of course, our strongest data sets are going to be in cards. And we can say that we do see it, albeit potentially indirectly. One of the strongest value proposition for cards within B2B commerce is to accelerate and de-risk collections. And we have seen acceptance from organizations, even very large organizations where liquidity is not fundamentally, or access to credit are not going to be their issues. So I think you can draw a reasonable hypothesis that they are essentially outsourcing collections or taking a different approach to managing collections by accepting cards where perhaps they haven't in the past.
And what's interesting about that, if we think about what changes that behavior, right? That's not going to come overnight. So it's probably been building up for a while for you to see that as well. So one to watch probably through Q4 and into Q1 next year. So we'll certainly publish this data again on our next two insights and get people updated on what we're seeing. So that sort of wraps up what we wanted to share with you on the data coming off the Demica platform. And we'll move now on to a discussion about transforming the landscape of B2B payments. I think the thing that's most sort of surprising to me when David sort of brought this slide to us was the sheer scale of the B2B market. I had no grasp, David, that it was this large. It'd be great if you could share with your insights, because clearly you've been with Track, been immersed in this data set.
My pleasure, Matt. Thank you. So sharing a Mastercard view, we of course came from this first column, this personal consumption expenditure. And that's a tremendously large market, 50 trillion in volume per annum. And you can see how cards have around the world become ubiquitous as a method of spend for this category. But if you put even this tremendously large category into context, it pales in comparison to B2B, as Matt said. And that's why I think there's a lot of energy around new entrants, different types of non-traditional players focusing on B2B right now. And of course, if you're sitting in my seat, the first bar you're going to look at from this 125 is that little orangish bit that says 2, as in roughly 2% of total B2B spend is on card. So if you break into this stacked bar, round numbers, you're talking about 125 trillion in volume, but roughly just $1 trillion or so in revenue per year based on different estimates, or around 8 basis points. And about half of that comes from liquidity premium paid by a bank treasury to a transaction bank. So there are very few organizations in the world who are able to capture roughly half of the revenue opportunity as it is realized today. Now, B2B cards are attractive. It's about 12% of total revenue against 2% of total flows, but it's niche because we need to fix the economics and the ergonomics associated with that as a payment type. And the industry is doing a lot of the right things to do exactly that. And I would expect cards to be far more relevant in this space in the years to come, as you probably expect that I would, Matt. But I think
so I'm going to cut across you there and just ask Megan for a moment. Do you agree with David that cards are going to become, more dominant over time in that B2B space, or does the bank see it in a different way?
I mean, I think there's a role for cards to play. I think Greg might get into this a little bit more, and he talked about this at the beginning. The commercial space in general is looking for the same optionality they have, in their personal lives, right? So how do I get the data? How do I have options across my payment type? So while card, I think, is key, it won't be the only one, but we definitely see it increasing for sure.
Sorry, David, I cut across you there, seeing whether we could provoke a slightly more contrarian view, but
I saw what you're doing there. I think you put in the word dominant. That was your word, not mine. So I think my view is probably in line with Megan's, and that it will grow. I don't expect these colors to flip. And for that reason, I think we can really focus our attention on account to account, this lion's share of the spend. So we're talking about domestic account to account being roughly 70% of total volume, but only about a quarter of revenue or less. I've seen different estimates here. And I think we know the primary reasons there. Generally speaking, people are trying to make money by moving money there, whereas it's a little bit more difficult to embed services along with movement of that money, as of course you would foreign exchange in the case of a cross-border transaction. And so I think the real takeaway here from our point of view is that it's very difficult to make money if you're just by moving money. And so the key to is to embed services. And I think from a Mastercard point of view, we would take the view that you don't just embed services by splitting up the transaction, looking at just the pay side or just the receive side, but rather, in the end, it doesn't really matter how the money moves. It's what combination of value is each side looking for, and then how can you align the interests of the various stakeholders involved to do their part in providing that value in a way that makes sense for everybody. And I think we'll talk about how complex that is here in the next slide or two.
Yeah, and I think it's that complexity that really comes through, right? The ecosystem is really complicated. And I think certainly everybody on this call, but I imagine many in the audience today will see various parts of this ecosystem, right? We've all, been participated in some aspect or another in those middle slices on that. So I wonder whether, David, you could just introduce this, and I'd love your perspective, Greg, on what the challenges you're seeing in the B2B space.
Sure, happy to do that. So buyers come from and suppliers come from very different business models, and they therefore have very different needs. But they have to deal with certain kinds of players. You need banks in this flow, deposits, credit, rails. You need ERPs in this flow, managing your purchase orders, invoices, and of course all of the processes that lead up to facilitate that commerce. But interestingly, both banks and ERPs are fundamentally designed to meet the needs of the entity. Primarily, as I want to say, purely on a standalone basis, but that's how they were built. And in fact, banks are regulated to limit their size, so they can't be the all be all end all network solution. I think our governments have taken a deliberate stance there. And so you then introduce these networks that then bridge these entities, like these procure to pay systems, for example. And I think the simple truth of our ecosystem is that each of these boxes represent very fragmented industries. If everybody had the same bank, I don't think we'd be having this conversation. If everyone had the same ERP around the world, I don't think we'd be having this conversation. But of course, that's not the case. And so the takeaway, the so what here is that you end up with just a tremendous number of data silos that makes it inefficient to capture data, to move data, and then to absorb data that someone else is sending to you. And the impact is widespread from an efficiency point of view or working capital.
And Greg, what is your perspective?
100% with David on a lot of the issues. We see that consistently, and those are the challenges. If you think on the A to A payment side, and then we'll build into this, one of the challenges to move away from traditional methods has really been there's a lot of existing relationships between businesses. Businesses typically interact with each other, not on a one-time fashion, but it's multiple. They have the ability to get credentials to be able to do a traditional, in the US, ACH type payment or wire. So, it's very difficult to shift off of that. And building on what David's talking about with regards to this ecosystem and the payment itself, is it's all driven typically today by batch. And I look at this and it always amazes me, because traditionally, the ERP or legacy systems are all batch driven. You get up to the payment and you generate a batch file. The batch file is either going to the bank that accepts the batch file, in the treasury systems, or they go to some back end system that's managing a batch file. That in itself creates a lot of inefficiencies, obviously, because now that is the point of integration between systems. Batch, you cannot handle real-time tactile feedback on transactions coming in and out, and it creates additional reconciliation and just back office issues because everything is not really connected in an integrated manner. So that is really, driving a lot of the issues. Now, what's happened is there's attempts at innovation around this over the years. For instance, with the banks have greatly invested, especially in the US, around real-time payments. APIs are now available. The interesting thing, though, is an API, having an API and having a payment that's real-time doesn't necessarily solve the problem, because what's happened is the originating solutions are pitching batch files over, now processing them into an API that's real-time payments, but the real-time aspect of a transaction fully integrated from a legacy system all the way into the bank, into the rail, is not happening because the existing infrastructure, the investments in the ERP systems, the investment in the treasury systems really hasn't created this integration point that's been very critical and missing to really make a change in the B2B payments. So, we see the move to integrate is needed. The issues are prevalent with the existing infrastructure. The businesses, are reluctant to invest. The banks don't have the expertise of the ERP world, beyond the payments. And there's this middle chasm basically that exists that's very difficult to connect. So integration, the batch processes, and the other thing that creates is just the data and the ability that all this data is siloed. It does create a lot of back office issues. I hear this multiple times from businesses where information they're getting from their payments, because it's batch and they're getting old information, sometimes weeks or even a month old, when if they had access to that information real time, there could be a lot better decision making up front. So that the data disparities and just lack of visibility is super problematic to B2B payments.
And it's interesting listening to you say that, right? Because as a business like ours that's working with clients in about 60 or 70 countries, I could take that same conversation and replicate it by region or probably even by country, right? Different sets of nuances in North America and Canada, including Canada, as well as down into Mexico, and then completely different sets of issues in Asia, as an example. And I think that that's one of the really big challenges here for cross-border trade. Because we can solve it in one area, but it doesn't change the fact, to your point, David, that you said earlier, that domestic payments are only an important but not a dominant set of the overall landscape. So this is going to be a problem I think that's going to be with us pretty much for the entirety of our professional lives. We can hopefully compress it, but it's more the landscape that we're going to be sitting with. So if I look at then what's the next issue that we're seeing in working capital solutions, the thing that we really notice is that the buyer-led solutions require real challenges to roll them out and get acceptance at scale. And one of the reasons for this is the fact that we each start with a single supply chain program. It might be an approved payables program, it could be dynamic discounting or a virtual cards program. And then we seek to engage thousands of suppliers to join up, but on a one-by-one basis, right? So it's product-centric, it's buyer-centric, it's done on one buyer. And the purpose of that one-off engagement means that we rarely, as an industry, penetrate deep into the supply chain. It's well known and well documented that typically the penetration is really strong at the top, right? For the largest, more strategic suppliers, banks are very good at engaging with those. And penetration is rising at the very tip or the very long tail due to virtual cards and the growth of that sector overall. But there's a real challenge in the middle, and it's not just a small slice, it's actually a really large part of it. And for us at Demica, we think this is probably one of the most important areas to focus on to really drive adoption. I mean, Megan, you're obviously, supply chain finance falls under your remit. This gives you a really interesting perspective. You're probably one of the few product leads that we know that has both supply chain finance and payments. So, congrats, it's great place to see you having both. What are your observations?
Yeah, thanks, Matt. It's an interesting slide because it really talks about the buyer-centric approaches, right? And they're really geared towards the buyer's immediate need for working capital and hence the focus towards their key suppliers. So at the outset of a buyer-centric program, the buyers start to receive the value of their working capital, and then they slowly move down the supply chain depending on their working capital and their associated costs. But the buyers need to look at their suppliers more holistically as a pool in its entirety and really gain an appreciation of what that true value brings of having the long tail in either an approved payables finance program, as you talked about, or a cards type financing program. But from the bank perspective, it really becomes kind of a question of capital and risk and the return for multiple product usage and how we think about it overall. So we can take the lead and support multiple products to further go down the long tail. We try to, as FIs, take a portfolio approach in terms of how we look at what's available in terms of capital, give the client alternatives to how they think about using their own capital to support, the respective requirements in the chain. And while the buyer has been the driver when it comes to supplier relationships, we're now seeing some movements around the banks to take a real holistic approach to the overall relationship management and really think about the core risk and the core products in the whole solution set. So we see advantages to us in this chain by having a longer term holistic view across the whole chain and not be so laser focused on one particular product.
But I think that makes complete sense. It requires a really joined up approach within a bank, right? I mean, we've seen, right? We've talked about what's unusual about BMO having payments and SCF with you. We see it in different ways in different banks. They're integrating products and creating a coherent offering to the supply chain is very challenging for all the reasons that we all know. So I think that this is likely to be the sort of landscape for a while. I don't know whether, Greg, you've seen any innovation in the partners that you've been working with that might address this before we move on and talk a little bit more about track.
Yeah, no, I completely think there's a lot of innovation going after this space. You know, it is getting access to the whole ecosystem that is the challenge, and has been the challenge, where the focus has been on you know, the large businesses typically, and the middle has been left kind of just out to fend for themselves. I think technology is in integration, and we spend a lot of time focused on this, really becomes the key aspect of bridging that gap and bringing access, you know, working capital capabilities to all segments, you know, both small businesses, mid and large businesses, and providing the optionality, giving them access to capital when they need it and when it's important. So we are, you know, very focused on solving for this ourselves, and think that there's a lot of opportunity now going forward as we evolve B2B payments and bring in the latest technology and bring in the integration and be able to connect all these partners together, and the ability to move money and, you know, do all the underwriting. All that creates a great opportunity to address this.
So I imagine, David, you're going to tell us that track is the panacea for all problems. So let me put up a slide just to help you provide the landscape to that. I think we'll move across, given the timing. We'll skip over the productivity challenges. I think we've covered these really well earlier in the webinar. So if we move on to track, David, give us an introduction.
Sure, thanks, Matt. So I think the big takeaway from my point of view from the last slide is that banks and fintechs have built just fantastic customer relationships. I think that you can't take that away. We can talk about the things that are not in place, but everything begins and ends with those fantastic relationships, and that becomes the core on which we build. Before I actually get into the slide, there's this turn of phrase that one of my contemporaries at Mastercard coined, which is, whether you're Warren Buffett or Berkshire Hathaway, you're not a Mastercard customer. And that's really important here. The banks own the customers. The fintechs own the customers. Mastercard does not own these corporate clients. We enable our partners. So if we look here on the left, you can see very clearly that buyer payment agents, organizations that meet the needs of their buyer clients, they sit between Mastercard and these corporates. So, for example, BMO could be a financial institution here. You can talk about Transcard being a non-financial institution here as a buyer payment agent. Similar story on the supplier payment agent side, where there is a layer. And what this essentially does is it unbundles the jobs to be done. And let's use supply chain finance as an example quickly. Let's say today you're a buyer payment agent, you're a trade bank, and you're doing all of these things. You own your buyer customer, you're underwriting, you're marketing to suppliers. That's a lot to do. And this model moves towards a little bit more of a specialization where everyone is a specialist. Buyers are treated as customers, as they are today, far and wide. But maybe the difference is suppliers are in all cases treated as customers as well, as opposed to another member of a broader network. And so the way that there's this concept of open loop versus closed loop. I think that when I joined Mastercard, I didn't know the difference between those and a triple toe loop. But I think of it kind of like an Apple. Well, Apple has their walled garden. Yeah? And they will control everything. And when Apple and the iPhone started, they didn't even allow third-party apps, right? But over time, they opened up and now third-party apps came in. Compare that to a Google, where with Android, there's a lot more flexibility in who can offer what experience. To Mastercard, the world of these little micro networks, I say little, they're obviously very huge. We're talking about millions of suppliers. I don't mean to diminish them in any way. But it feels to us like the 1950s, where you had a credit card for restaurants, you had a credit card for travel, But then something really important happened, and you had these 17 different banks, and I'm telling our founder's story here, come together, and they agreed on this concept of reciprocal acceptance. I can pay you, you can pay me, I bring in a buyer, you bring in a supplier, we can all pay each other. And all of a sudden, cards became ubiquitous. When we look at, that was the journey for PCE, that personal consumption expense that we saw on the earlier slide. Mastercard believes that that's going to be a similar journey for B2B. But to do it, where you basically create this reciprocal acceptance, you can't be greedy. You'll say, I operate a network, but I don't play in the network. And so that's why there's a layer between us and the customers. And we say, look, I understand I have card in my name, but there's no pressure to say you have to pay a certain way. So totally rail agnostic as well. And the services here in the center, there's just a couple of principles. If you're going to play in this network, we got to know who you are from an entity point of view. Buyers and suppliers, tell us what you want. Put your bid-ask spread. Suppliers, what is it what are your problems? And we'll find solutions to deliver those. You want to get paid sooner? Great. What is your willingness to pay? Understood. We'll originate assets, whether that's purchasing a receivable or paying by card or et cetera, based on those preferences. And then we need to solve some of those data problems that we talked about a little bit earlier, as far as standardizing what data is sent and how it is sent, thereby making it a lot easier to absorb. Once you have these kinds of things in place, well then some of those challenges around efficiency and working capital starts to erode, and you can start to see, Matt, to your previous point, you start getting access to a huge number of suppliers for financing that potentially couldn't have gotten access otherwise.
And it's interesting, right? Because what you're describing is a massive project, right? The establishment of an open loop network across B2B for supply chain finance, dynamic discounting, and card. Yet it has to start from the first early adopters getting value, seeing benefit from it at the start before it can build up to that. Greg, you were one of the relatively early adopters, signing up both as a BPA and an SPA to track. It'd be great to hear your view on why you did that and what the value proposition is for your customers and your business.
Absolutely. And, we look at this space. One is we, have been in both B2C and B2B payments for quite some time. We always knew B2B payments were challenged, and spent a lot of time making sure that as we address the space, it would have longevity and address a lot of the issues we talked about. If you think about this payment on BPS track, think about a buyer and supplier exchanging electronically information between purchase order invoice, originating a payment. If it's through the RTP transaction, being able to get real-time settlement information, being able to go post that update back in both the buyers and suppliers system, and to be able to do all that within a second. That is an incredible leap from what exists today, what we talked about earlier with the batch. And that is something that is super exciting as far as an evolution of where B2B payments can go, and we are all about that. The challenge is this connectivity issue. So if you think about from a buyer or supplier, they've invested in their legacy systems, their ERP systems. So how do you, the question became, how do you enable that or embed inside of those systems to enable this really, cool transaction? Also the banks, the banks and the ecosystem, banks and buyers and banks and suppliers have long-standing relationships. So how do you embrace those banks? The banks have invested, like we talked about earlier, in open APIs, leveraging the open banking network to be able to facilitate and manage all that. That becomes, from our perspective, that was the issue, tying in, businesses, the banks and the networks, the rails, to be able to facilitate this BPS transaction. And that's, where we specialize. That is our specialty as a non-financial institution on the BPA side, and the SPA side. It's really about enablement. We're here trying to enable all those entities to be able to communicate and work together. So we're, big advocates of BPS. We like what it brings. It addresses, all the things that we talked about before as far as the challenges in this space, but it also brings a lot more opportunity. Now having real-time access to information and payment information and full control, the ability to opt in for supply chain financing on a real-time basis, in a very embedded basis, it creates, just tremendous opportunity. The ability to connect into various segments. So no longer does the buyer and supplier need to be, large customers only. They can be large and small. The connectivity brings just a lot of innovation. The other aspect, with now tying data with the payments together and getting access into the levels of data, also allows for a lot more innovation and a lot more sureties, especially on supply chain financing, to understand more about each party, the current state they're in, the transactions themselves, being able to kind of control and manage where those are going. The supply chain financing, I think, is a key element in making the success of BPS Track. I think David made a great comment earlier, which is about moving money is not about the payment itself, but it's about all the services that come with it. And with BPS Track, you're getting a whole suite of services. It's not just about ACH transaction anymore, about moving money from point A to point B. It's about getting access to these services. It's about getting really the ability to update your systems real time, getting better visibility into not only the payment itself, but the information. So I think really is a large step up in the innovation for B2B payments.
Before I ask for your perspective, just as a reminder to the audience, if you have questions for us, please just type them into the chat area. We'll pick them up as we're going along. We have about a quarter of an hour left on this webinar, so plenty of time to cover off questions if there are any. But back to you, Megan.
Yeah, I don't have a ton to add to what Greg's commented on. I totally agree that it's not the how, it's not the payment type, it's the what, it's the wrapper of the data, the information for clients. How this centralizes their whole payment infrastructure to create flexibility is really key for clients. And it takes them out of a very siloed approach to mentality in terms of how they think about their entire flow into the services part, which is key for them. From a bank perspective, what it gives us is a more holistic view on the risk side and making sure we appropriately match up our risk and our offering against the entire product suite and chain for those clients. So it allows us to be a little bit more comprehensive because we're seeing both the buyer and the supplier side of everything, which would be key for us. And to Greg's point, the data analytics around it really helps us from a risk management perspective, because again, we're seeing both sides of both the transaction, but also the whole chain through suppliers as well as the buyers. So I think Greg encapsulated it really quite crisply in terms of the value that it can bring to everybody across the entire chain.
From our perspective, we think that this could really transform how supplier onboarding works within the supply chain finance space. It's the perennial problem. It's the thing that those of us who are industry practitioners have been focused on probably the most, right? Which is how do you get deeper into the supply chain? And I think that the thing that was probably most sort of exciting about where, our understanding of Track, once David really walked us through it, was the fact that it was much more supplier centric. By enabling suppliers to register their payment and price preference in Track, and therefore somebody who's rolling out a program is able to see which suppliers want to join the program and on what terms. It ceases to be a push process and now it's more of a pull. And I think that ties back into many of the important themes around ESG, of course, but it actually completely changes the economics of rolling out these programs, because suddenly you're ceasing to try and push it down one particular program, right, where you're having to put all the investment onto one particular buyer, and now you can amortize the cost of supplier enablement across an entire network. And I think that what you guys have been building here is really exciting. I know from questions that we've had together from banks that the banks want to understand, what's going to go through their own network, what might come across track, etc., how this might work in a bit more detail. I wonder whether you'd like to offer some observations to that.
Yeah, I think you've nailed it, Matt, in terms of it's really the transparency for us in terms of the flow and both sides of it, and agree that sometimes the suppliers feel like second fiddle in terms of where they show up in the value proposition in the chain. So to be able to show up with transparency on how they want to pay and their ESG offerings to the community, I guess that's how I call it, a community versus a network, I think is really key. And again, as I said before, what's super helpful for us is the transparency to see in one spot all sides of the equation, so we can really manage our risk appetite, but think about how to be super supportive to both sides of the equation from a product offering, but also a capital extension perspective.
David, we have a question from Michael Seguin at Standard Chartered Bank, and it reads, what is the single largest challenge to scaling up BPS from early adopter to real scale? What's the timeline do you expect it to reach critical mass?
I think that critical mass, as with most networks, will occur in pockets before it is available generally. So if you look at the evolution of any B2B network, generally speaking, they've started in pockets. That could be an industry vertical, usually has been. That could be a market or a geography. It could even be kind of product centric, although of course we're moving very much beyond being product centric. My sense is that the biggest challenge to getting there is that if you look at the lower right-hand corner of the slide, it actually hints at it. From a supply chain finance point of view, we have the objective of delivering these working capital solutions to a huge number of small and medium businesses. That means we have to have a wide tent. We need to be able to bring new players into this space and enable them to complete the jobs to be done, to bring suppliers on board, to capture those supplier preferences, to ensure that we know those suppliers suitably and the banks know the suppliers suitably to be able to finance those transactions. And so if you look at merchant acquirers, you look at regional banks, these are players that you don't often see when you think about supply chain finance. These are not segments that probably are top of mind for you. But bringing in these players and then enabling them to have a place in this ecosystem, I think will be part of the journey. But we believe that this is actually what makes the network very special. And bringing in these new players, and they're hundreds of thousands, these are millions of suppliers that they really know, and that where they can go deep with those suppliers. What are your preferences? I'm not trying to sell you a card. I want to, I care about our long-term relationship. I think that's what's going to be both on the critical path to a critical mass, but it's also going to be the long pole in the tent.
Yeah, and I think that's correct, because if you think about who dominates supply chain finance today, it's the largest transaction banks, right? Citi, Deutsche, Standard Chartered, etc. But how many of the small and mid-sized suppliers are banked by these banks? Obviously, a much smaller fraction of the market. Without getting into the regional banks and the fintechs and also the merchant acquirers, as you talk about, will never successfully penetrate the long tail, because you need that customer relationship to actually justify, onboarding and getting that price and payment preference. And I think to me, that was the thing that really stood out about Track, which is the person that's going to be approaching the supplier to ask them about what they want from Track is going to be somebody who has a relationship with that supplier and is going to be doing it once and storing it centrally and making that available to those that are offering supply chain finance. And one of the things that there are many things that are interesting about Track, but one of them that also stands up to me is the fact that you can see here it's split between the network. So the banks, the large suppliers are still going to get financed directly by the bank on their own platforms, right? This isn't about disintermediating the banks from those programs, but more about capturing extra revenue that's currently not being caught by getting into the middle and the long tail of the supply chain. So I think there's a lot to go for here. If we just talk about a little bit more about how this might work in practice. So if the supplier payment agent has been talking to suppliers and picking up their appetite for early payment, the price that they would be willing to accept for discount, that's coming in on the right-hand side, being stored within BPS. And then, of course, you've got the maturity payments, whether that's from payment factories or other network environments, effectively saying, hey, I'm going to be making this payment in the future to this supplier. If those things match, then Track is able to route that into Demica, and then we'll be able to then enable the financing at that point. And you were talking about, Greg, about one of the exciting things is providing supply chain finance, one of these incremental services. This will unlock supply chain finance for a whole network of fintechs and non-bank funders, but it is also going to unlock it for many banks that perhaps don't bank suppliers in particular countries, right? We expect we're going to be running a waterfall in the funding network for risk distribution. So whoever originates on an approved payables program, the buyer payment agent will get right of first refusal to fund. It's their program. They onboarded the buyer. Really critical that they get that opportunity. And you might think, well, surely they would have done that already, because they're only going to be routing the stuff that they don't wish to fund. But actually, that's not true, because they may not be aware that a particular smaller supplier wants early payment. So this takes out the marketing effort for the medium and long tail. So a large bank has originated the program, can look at funding, and only at that point they'll fund directly the large suppliers through Track, those that they wish to fund. And then those that go beyond that, maybe due to size or they haven't got the right KYC and AML, or they're in a jurisdictional currency that they can't fund, then that will flow into the banks and non-bank financial institutions that sit within Demica's funding network. So that's really the heart of what we're bringing. I think that there's a lot of opportunity, David, to widen this out into other products, away from approved payables into receivables finance. And hopefully we might even see the market, like the derivatives market did with ISDA. Hopefully in supply chain, we might even move on to some universal funding contracts, which I think will create efficiency for many of us in this particular space. I mean, how do you see it evolving from here, David? Do you think it's going to start with payables, or do you think the traction is going to be more with receivables? Where's it going to come first?
I think that we're starting with payables, and we have a very strong proposition. The interest has been fantastic so far, and so we're moving at pace to roll out this proposition and to do it at a meaningful scale. From there, we'll follow where the market takes us. Already, the pull has been very strong to expand geographically with this payables proposition. Currently, focuses US and Canada. Europe and the Middle East and Africa and Asia, we're getting strong pull across these regions, to exclude LAC, Latin America. But yes, to your point, if we are intermediating payments from a buyer to a supplier, then there's no reason why, if we know a buyer is going to make a payment and we have the data around that payment and how much they're going to pay, et cetera, why an undisclosed receivables finance or supplier-centric financing might not be possible as well. But we're gonna start with payables, and we're going to then let the market guide us, both as far as geographic scope as well as product scope.
And I think Daniel will be telling us that we're about to hit time quite shortly. Do we have time for maybe a question or two that remains?
I think we can squeeze one in.
We can squeeze one in. Guys, if there's anything you'd like to add from the audience, please feel free. Nothing quite coming up at the moment, which is good. Well, I think this is probably a good time to wrap. Any other housekeeping points, Dan, that you want to cover?
Just to close off, really. So, I mean, if you want to say thank you to the panel, then I'll let the audience know what they can expect next.
Well, thank you everybody for joining us, David, Greg, and Megan. I think this has been a great discussion. And we know that this is the start of a long journey. So if you have questions, please feel free to reach out to any of us, and we'll pick up the conversation from there. Thank you.
Thank you.
Thanks, Matt, and thank you to our panel. Thank you everyone for attending today's session. Once you leave today's webinar, you will receive a survey on the presentation, and we'd really appreciate it if you would complete that and provide the feedback. You will also receive a follow-up email within 24 hours with a link to view a recording of today's webinar. On behalf of Matt and our presenters, thank you for joining us today, and have a great rest of your day.